All right, so we're going to be talking about liquidity for beginners. So this way you can get a complete understanding of what liquidity is. This is not advanced. This is very beginner friendly, very simple, very straightforward. Price moves because of liquidity, especially as a beginner. You're watching these YouTubers. You look at the market and you see a random spike out of nowhere. You're just sitting there watching this market, and then boom, spike happens. Huge engulf up candle, or vice versa, huge down candle. And you're like, whoa, what is that? That happened out of nowhere. That could be one of two reasons. The one we're going to focus on is that usually happens because liquidity is at work. Excuse me. It's being shown where price is drawn to next. These spikes that you see in the market, they're not random. They always happen in conjunctions to other confluences. There's other reasons that are at play for liquidity to move the way it does. So understand that liquidity, these spikes, they're not random. They're engineered. What is liquidity? At its simplest term, liquidity is just a cluster of buy and sell orders at a single place. Think of it like a jar of cookies. You have one cookie in the jar, okay? Now you have two cookies in the jar. 3, 6, 12. Now you have a cluster of cookies in this jar. That's essentially what liquidity is a cluster of buy and sell orders, stops or entries. Those are orders, and there's lots of them in these jars or at these key levels. You know what I'm saying? So liquidity is a large cluster of stops and entry orders, and price needs these orders to move the market. If I wanted to buy a Pokemon card from you, I need you to be willing to sell it so we can create an order within that transaction. And the more people that are selling that Pokemon for $15, you're most likely going to have your sell at $15. Now that becomes a cluster of sell orders from the Pokemon side, because you guys are all looking to sell your Pokemon at $15. So now there's a bunch of people out there selling their Pokemons for $15. That's what liquidity is. It's a large amount of orders at a certain level, and the price needs that to move. If price wants to go up $5, it has to have a willing buyer at $5. So where does this liquidity typically sit at? Because I'm going to go into the market. I'm going to look for liquidity. Where can I find it? How can it make sense to me? So at its simplest, liquidity sits above equal highs and equal lows. In case you don't know what an equal high is, or a swing high, is a 3 candlestick pattern with the middle candle being at the highest point and the candle to the left and to the right are slightly below the middle candle's high. That creates a swing high. Now you pair that 3 candlestick pattern, copy and paste it right next to the other side. Now you have 2 equal highs. The same is for a swing low, is that we have a middle candle at the lowest point, the candle to the left slightly higher, the candle to the right slightly higher, creating a swing low. Copy and paste that to the opposite side, same level, same pattern, equal lows. Now we have an understanding that there's going to be liquidity down here and also up here. You're probably thinking, like, how do you know that? Because retail traders are seeing this price action as support and resistance. So if a retail trader is buying near these swing lows, he's most likely, or she's most likely, going to put a stop loss right here, because this is where it feels safe. They believe that this is a strong support zone and price doesn't want to go below it. So that's where they're going to put their stop losses at. And the more obvious that it is for me to see it, the more obvious it is for you to see it, the more obvious for us to see it, the more obvious it is for other people to see it as well. It's not rocket science. And the more the people see it, the more people are going to place their stop losses there because they believe that's a safe zone. But they are now becoming our liquidity, our clusters of orders now, because that's their stop loss. And the more people that put their stop loss there, the more liquidity the market can get out of them because there's more people waiting down there. So that's where liquidity sits. It's below these equal lows, these swing lows, and these obvious points because retail traders love to put their stop losses there because that's where it feels safe to them. And that's why our liquidity clusters are there. Why does price go there anyway? Well, liquidity is for fuel for price action. Think about it like a car. Without fuel, you ain't getting far. And if you want to go faster and go longer, you need better fuel and larger amounts of gasoline. The same is with these big time players that want to make these large orders in the markets. Compared to me and you, we're beginners. We're maybe doing 1-3 contracts. But don't forget, there's people that have been doing this for decades, generations, can do thousands of contracts, tens of thousands of contracts. And these large players, they can't just hit a button, enter here, hit a button, sell there. They need people that are willing to sell their orders or buy their orders so that way they can fill their positions in. And that's where these liquidity pools come into play. So the more liquidity pools that they are, the more opportunities for big time players to be able to enter. That's why price is attracted to these areas with lots of orders in them. So big time players can be able to use that to their advantage to enter at the best possible price. That's why price goes there, because this liquidity, it's fuel for the pricing. The same how gas is fuel for the car. The same for a rocket ship. It's not going to go anywhere without the proper fuel in it. And it's going to need an X amount of fuel for it to get off and get into outer space. You can't just get into a rocket ship and expect it to turn on and go into outer space. Like, there's structure that needs to be going behind it. There's a certain amount of fuel that needs to get into it. And there's a certain type of fuel. The best type of fuel that you can get. That's why price goes there. Is because they use that as their fuel, as their gasoline to go up or down. There's only a few things that happen after liquidity gets taken. And most of the reaction that comes from price being taken really depends on the context that you have for that day. Excuse me. But what I've noticed is that after liquidity happens, after liquidity gets taken, it's really one of two reactions. I mean, I guess you could say three. But it's typically a continuation or a reversal. Sometimes it even starts to consolidate and do nothing for the rest of the day, which is wild. But that's typically what you can see after liquidity gets taken out. It's either going to consolidate, or it's going to reverse, or it's going to continue higher or lower. Depends on the context. Liquidity alone doesn't predict the direction by itself. Because like we just mentioned, two reactions can happen after getting caught by liquidity. In this example that I have here to the right is that we have this swing low, which is a 3 candlestick pattern. Middle candle's lowest point. Candle to the left, to the right are higher than the middle point. This creates a swing low. Retail traders see this as a support line. What does price do? Takes liquidity. Continuation. Or it would be vice versa. Price takes liquidity and it could have continued going down. You know, but it depends on the context that you have. You don't ever just want to just look at liquidity and use that as a trading signal. Again, just mentioned it. Liquidity is not an entry signal, guys. It's not. Do not go to the market and expect to just enter off of any liquidity zone low, any liquidity zone high. Don't do that. Don't just buy or sell where liquidity is, because liquidity is there and you're able to identify it, so it can tell you where to put your focus and your intention, not when to trade. If you want to trade liquidity, you still need more market structure. You need timing, confirmation, other confluences that support your trading strategy within that day. So now that we got all the basics covered, is like what liquidity is, why the market needs it, why it's important, how to identify it. Let's go find some easy live chart examples on NQ to be able to drive this point home. So now we're over here. We are on NQ. This is very beautiful. We have a few examples here. So as you can see here, the most obvious swing high at this point is going to be this chart, which is Wednesday 12th. Boom. Price comes up, takes liquidity once, twice, a total of 4 times, and then reversed. You see how obvious the swing high is? The middle candle being its highest point, the candle to the left is below it, candle to the right below it, creating a swing high. Price came up to it, grabbed it, consolidated a little bit, reversed. Huge down candle. Right? Let's take this a little bit further now. So now this is Friday. We have Thursday's low, swing low, so whatever the swing low for that day was, as well for the swing high. So we'll do yesterday's high, yesterday's low, and then yesterday's prior day's high or low. Yesterday's low. Yesterday's prior day's high. Or what I like to say is yesterday's high. And then we're going to go ahead and drop to the 15-minute. And look at this. So price created a swing low around 11 a.m. That's when they created the low for the day. And around Wednesday at, what's that, like 3, 4 o'clock? Yeah, 12. Like around 2 to yeah, about 2 or 3 o'clock, something like that. Not really too much with the military time, right? But anyways, as you can see, price created a high around that time. Price reverses. Oh, after that obvious swing high was taken out, price goes up, grabs it, reverses all the way down to the next liquidity pool, even going down a little bit more than that. After price created the swing low right here, which is Wednesday at 22, pretty much right at the Asian session, the beginning of it. What is price doing? It touches it, goes up, goes to liquidity, it consolidates at it, continues. That's why you can't just look at this and be, oh, okay, price came to a liquidity zone, let's sell here. No, context is king. Price broke down yesterday's prior day's low, created a new session low, came up to prior day's low, hit it, came down a little bit, continuation. Price took out this mini high right here, this low short-term high. Price rallied back down to yesterday's high, and then reversed. Price came up, hit that obvious swing point high that we mentioned earlier, and then what happens? Reverses. Price has now broken prior day's low and prior day's low. Yesterday's low and then yesterday's prior day's low. And now look where we're at. down here. The market moves within this liquidity. You had multiple opportunities. If you marked out before Wednesday that obvious swing high on the daily, you would have understand that there's a liquidity there. Once price takes that out, you can understand that you can expect a reversal. Most likely than not, because of the context that we have. We're in an overall bearish market structure at the moment. Price created that high. Okay, now let's wait until price hits it. Price hits it, reverses. That's why it went. And once price hit that, it smoothly went down because there was a cluster of buy orders and sell orders, entries and stop losses here. Large institutional buyers. That's a terminology for a different day. Boom. Boom. Use liquidity as context, guys. Don't just go in here and then just trade whatever. This can be a little complicated at first, but you'll get the hang of it. Understand what a swing high is, a swing low is, and then memorize how previous session highs and lows react to the daily session, the current intraday session. Because prior day's high and low is super important to why the market moves the way that it does. I even do yesterday's prior day, gives me more context. Understanding liquidity and price movement within itself is a way better indicator than any other indicator I have found. Understanding why price moves the way it does has provided me the best understanding of market structure. It's understanding these candles, they have a story to them, and they leave breadcrumbs for us to pick up. We probably would never make the amount of profits these huge players make, but we can make partials off of it. We can make a couple $100, a couple thousand, a couple 100,000. It might not be the millions that they're making, millions of billions that they're making, but if we can get a piece of it, that can change your life. It can change my life. But I appreciate you for watching. One homework that I'll leave you with is mark out previous day's highs and lows and yesterday's prior day highs and lows, and just see how the market reacts to those levels. Is it a reversal? Is it a continuation? Take notes. Get an understanding of what it is that's happening within these markets. Don't be lazy. Journal what you're seeing. Get a good understanding and make this a passion for yourself. Thank you for watching. God bless. Have a great night. Or a good day, depending on what time you're watching this. Or even a good morning. Peace out.